Alright, what's going on, guys? Welcome back to my channel, Engine Trading. Thank you guys for tuning in. And for today's video, I'm going to show you guys a very simple trading technique that you can actually use. It's actually very popular, but a lot of traders tend to overlook it, or they don't just zoom out on the market to actually observe when it is actually being formed. And I'm going to break down a few things so you guys can spot it. And this pattern allows me to clock in about 6.5k and gold. I could have actually clocked in more, however I was being a little bit more conservative. So with that being said, please remember I'm not a financial advisor. I'm just a regular guy on YouTube who loves trading. I am sharing some of my trading knowledge with you guys. So please remember to like, comment and subscribe to this video. With that being said, let's just jump right into this chart. Okay, so first up, we're going to take into consideration a very well-known pattern, easy to trade. You can also incorporate it within your trading style if you haven't been doing so, just to make your life a bit more easier when you're trading. It's known as the bull flag. And another one that I'm going to show in here is one that is similar to the bull flag. A lot of traders tend to, basically call this the bull flag as well. However, it is slightly different because of the consolidation of the market at the time. This one is known as the bullish pennant. But in terms of momentum of the market, if the market is pushing to the upside, then each of these patterns basically signifies that the momentum of the market will continue in the same direction. And you can find both of these patterns on the bearish market as well, which should also known as the bearish flag and a bearish pennant. So you guys can start to look out for these patterns whenever you're trading, just to make your trading life and your technical analysis much easier. I know everybody have their own different trading style, but when you incorporate pattern that is already been there, that has been trading over years, make your technical analysis so much easier. But for today's video, we're just going to take into consideration the bull flag. Okay, so now that you guys have seen two patterns that can signify the continuation of the market, and as stated, the one that we're really taking into consideration for this trade is actually the bull flag. So I'm just gonna draw my parallel lines here, so I basically just move this retracement that has taken place on gold. And also keep in mind, your trend lines are not going to always be perfect. Sometimes the market will tend to wick outside of them a little bit, but it does give you a more pleasing view of how to look at the market or see whenever the market is being contained. So as you can see, we didn't have any extreme push to the downside or extreme push to the upside, creating an even pattern. This was more of like a contained retracement, and that retracement was with respect to the momentum of the market. So as you can see, this is actually the momentum of the market, and this retracement is taking place with respect to that momentum. This is also a clear sign that that trend will actually continue to the upside. So whenever you are trading and you do have the momentum pushing in a direction, even if it's on a bearish market and you have a retracement taking place with respect to the market at the opposite angle, so that was the momentum and you have this retracement taking place like this, then that market will tend to break to the downside as well. However, if you are actually trading the market and then that retracement is being contained and you are within this region, however it is still in the direction or the momentum of the market, this is more like a sloping flag, and that will tend to break to the downside. So away with all of that, taking this trade was noting that alright, fine, that we had this retracement coming in with respect to the momentum of the market. So I'm most definitely looking out for the continuation of the trend, and also the fact that this retracement was basically in a contained format. As stated before, it wasn't any overly extended of market pushing to the upside or to the downside. So then I have my body of my flag kicking in, and this most definitely look like a flagpole. So once we have broken out of this channel to the upside and we basically retest back this channel, because market tends to do that whenever it's broken out of a channel or say a particular trend line or stuff like that, it tends to go back to retest that trend line or channel. So once I've gotten that retest and I have some nice dragonfly doji kicking in here, I decided to, alright, this would be a good trade, and I have placed my stop loss with respect to calculating my risk to reward ratio, and I've taken the trade right here. Give the market a little room by placing my stop loss somewhere within this region here. As I said, all of my stop loss are calculated, and when targeting a destination to the upside, you normally measure the distance of the flagpole to where the market create the first high point, and you basically pull it over to where the market tends to break out. I know it's way outside of where I have taken profit, I was being a little bit conservative when joining this pattern, so I didn't take into consideration the week for this particular trade. I just basically took my flagpole from right within this region, and I still was a little bit conservative even when I have done this. So pulling this over here, this would have been the hiding region of where I would actually put my TP for this particular trade, but I still was a little bit conservative because right in this region here was a support and resistance here for me, so I just placed my TP just a little bit over it. And if the market overly extended, that's fine. You don't have to catch all the pips within the market because this was a very nice trade, and as you guys can see, the profit on it was very rewarding as well. But some of the things that you most definitely should look out for when taking this trade is that if you want to be a bit more conservative, you can wait for the break of that upper trend line, and when you get that retest, then you can take the trade. Or if you're a bit more aggressive, you can observe the market from when that retracement is actually taking place. Or once the market is pushing to the downside, creating lower lows with respect to the previous low points. If the market push back to the upper trend line or push back somewhere within the middle of the actual retracement that is taking place. Once that market retraces back and seems to have created a higher low point with respect to the previous low point, this is also signifying that the momentum of this retracement is about to change. So if you're a bit more aggressive, you can also tend to get in within this particular region here, and you can maximize in terms of profit to the upside. So that's pretty much it. And as I stated before, I do expect that gold, the fact that this is the length of the flagpole, I do expect that gold eventually will get somewhere within this region, but I myself was being a little bit more conservative, and sometimes you don't have to chase after every pips within the market. You can actually take some trade, and if you get some retracement, and even though you're over a destination within this region, the market can retrace a bit before you get into that particular point. So yeah guys, thank you guys for tuning in again, and remember to like, comment and subscribe. Share this video with your friends. Peace out.